Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Trading in global equities was muted on Monday given a number of holidays. We have Lunar New Year festivities underway in the Asia Pacific, and in the States, markets were closed on Monday to observe President's Day. Now, in the week ahead, disruption from AI is likely to continue as a theme. Last week, nearly every part of the financial sector was hit, and strategists at JPMorgan Chase are urging caution on stocks at risk of AI-driven cannibalization. And other Wall Street firms are creating tools to capitalize on this divergence. Goldman Sachs, as an example, has launched a new basket of software stocks that goes long firms that will benefit from AI adoption and short companies whose workflows could be replaced. For a closer look, I'm joined by Stephanie Leung. She is the CIO at StashAway. Stephanie joins from our studios in Hong Kong. Thank you for being here. It seems clear that AI has ushered in disruption across a range of industries. How do you understand this moment in the evolution of artificial intelligence?
I think two things. Number one is that Anthropic released its latest model together with OpenAI, and they are much more powerful models than previously. And what these new models enable us to do is actually to build even more powerful agents. So if you think about the latest development, which is something called OpenClaw, it's basically an agent that you can deploy on your home PC. And actually, I don't know if you've tried it. I've actually started deploying my own agents in my PC as well using OpenClaw, and it's quite easy, to be frank. And it can help you to do a lot of things, right? It can help you to automate your daily routine. It can help you to automate any workflow that you specify. So I think the fear is that once these agents are kind of so easy to deploy, then you don't need to buy any software, right? You can just ask an agent to build your software, and it'll come back with what you require in a very, very short time and do it on a very cost-effective basis. So there's a question about, whether or not all these software companies will actually face existential crises. And I think we do have to separate these companies into two groups. The first group is the ones that have moat, which, from my perspective, the moats are defined as, for example, companies with a strong distribution, like Microsoft or SAP. These are very, very entrenched with the enterprises. And of course, the software companies that have their own kind of understanding of the data layer. For example, if you think about the securities companies, right? They have a very deep understanding of how to kind of think about security and how to survey the data to do their job. And these are not that easy to replace. You can't just tell an AI agent to build me a company with distribution or a company with a deep understanding of cybersecurity. The second group of company are the ones that have not a lot of moats. Those are I think companies that, for example, serve single purposes. For example, if, let's say, a company has a SaaS business that just focus on providing a scheduling tool, I think that is a moat that is much easier for an agent to crack. You can just spin up agents and tell it to build that. So I do think that there are disruptions to the sector. And then also, I think on a broader basis, if you think about simple kind of old school supply and demand, there's going to be a lot of supply of software that's coming, right? And the question is then, is there so much demand to absorb this supply? And I think given that the supply is also coming up at very, very low cost, that is a true disruption for the whole software industry. But I do think that the market has been selling down kind of quite indiscriminately, and also these are a bit overblown.
So one of the things that I want to focus on, the disruption from AI that has the potential to impact nearly every part of the financial services sector. Whether you're talking wealth managers, insurance brokers, even some of the big banks, boutique advisors. Now, I know your firm, StashAway, is a digital investment platform. Do you think that this is necessarily going to engender a lot more in the way of competition?
Yeah, and I think, believe me, this is like the daily conversation we have in the C-suite as well, right? And I think there are two things that I think that we need to think about in terms of whether or not these will disrupt the financial industry. The first thing is, of course, the regulations, because all of us are tightly regulated. For example, we have licensees with regulators in all the markets that we operate, and these are very, very strict kind of, I guess, regulatory kind of restrictions that we have that we need to operate within. The question is, if somebody builds an AI agent, right? You still need to comply with all the regulations. You need to file a license with the regulator. So, there is a level of expertise that is required to do all these. And I think from a regulator's perspective, regulators are typically slower to react to these kind of innovations, right? They don't have a framework to approve, for example, an AI agent. Can an AI agent actually give advice or not? These are sort of still unanswered questions because, the AI agent, of course, is not licensed. So I think that's the first kind of big question mark as to whether or not AI can, or AI agents, kind of independently can disrupt the industry. Secondly, if you think about all these kind of financial companies, we're not standing still, right? We're not sitting around and not doing anything. In fact, I think a lot of the bigger financial industries, companies, are innovating and sort of investing a lot of money into building out their own AI capabilities. If you look at for example, in JP Morgan or Goldman or even in StashAway ourselves, we're investing a lot in building out our AI capabilities. And those are, I think the bottleneck still remains the sort of, I guess the resources that you have in order to build these out, because using tokens or using these LLMs, it's not cheap, right? It doesn't come at free cost, and therefore I do think that companies with platform, with resources, and with regulatory kind of approvals will still remain the bigger players.
So we've seen how the adoption of artificial intelligence has impacted the hardware market, particularly in the Asia-Pacific region. So much so that we're talking now about a shortage of memory chips, particularly the high bandwidth memory that's necessary to work with these various AI platforms. Are you seeing opportunity here? How do you understand the shortage that we're seeing in memory?
Yeah, I think of course, the memory industry has gone through a lot of consolidation in the past, and now we have basically kind of three big companies supplying most of the memory chips. Memory historically has been a cyclical industry, and that is because basically it goes with the industry cycle, right? When the economy is hot, there's a lot more demand for memory and these kind of chips. When the economy is not so hot, then basically there is oversupply. And typically, I think if you look at the AI development today, as we go from kind of model training to inference, there's a lot more demand for memory because of the lengthened kind of context window. So when we do inference, when we ask GPT a question, we carry on these conversations very, 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 very long time. And therefore, there's a lot more that needs to be stored in memory for the model to be able to have a prolonged conversation with the user. And this is the main difference between inference and training. So in the past few years, when the AI industry or when token usage was actually mostly focused on training, the demand on memory was not that big, right? Right now, actually, we're just starting to see the increase and ramp up in demand for memory. And I think as the AI kind of agent usage proliferates starting this year, we're actually going to see even more demand. And the problem is that because the memory supply is actually focused on these three companies, it's not that easy for them, or it's not that fast for them to ramp up capacity. So I think at least for the next few months or the next year or so, the visibility of a memory shortage is actually still remains quite large. And if you look at some of these companies, they're still trading at pretty decent valuations because the market historically has viewed them as cyclical rather than structural. So I do think that there is more to go. Now, of course, in the near term, a lot of these companies are quite overbought. But I think these are companies that you add to if there is a correction. So
when you consider how the technology has been evolving over time, and I'm wondering whether or not there is a risk here that what we're talking about today as being cutting edge becomes obsolete 6 months from now. And
Yes.
that if you're investing in that, if you're making a capital expenditure in that type of technology, that you could be forced to remain competitive, you're going to be forced to have to upgrade.
Yes, but also I think because the demand is so big, I guess the risk of investing in assets that depreciate very, very quickly is today lower. So if you look at, for example, the NVIDIA chips, the older chips actually don't fall that much in value. Indeed, if you look at kind of the recent pricing, they've actually been going higher. And that's because the way it kind of, I guess the whole AI stack works, the most cutting edge hardware is used for training. But today we have an additional demand, which is inference, right? Which is basically, us talking to GPT and also using agents. These tasks actually don't require the cutting edge chips that are required as of training. So we have started another wave of I guess AI application, and these applications actually can make use of the older I guess older and less advanced chips. I think the analogy may be we can draw the iPhone, right? iPhone basically has a new version every year. But the old iPhones actually still retain the value because you can actually resell these to other other users that do not demand such a cutting edge iPhone. So perhaps this is kind of how I would categorize or characterize the AI hardware, because the demand is so big that needs to be satisfied. So, and also the demand is a spectrum of high end, low end, medium end. So I do think that the risk of kind of investing in technologies that depreciates or fades is lower.
Stephanie, before I let you go, we are obviously in the midst of the Lunar New Year holiday, celebrating the beginning of the Year of the Horse. Can I ask you to offer some wisdom?
This year is the year of the fire horse, which tends to be, I guess, fast running and I guess quite vivid. So I think in a sense, it sort of, I guess, gels with our view that this year we're going to see a lot of ups and downs and volatility and turns. Think about kind of what we've gone through already in the last month and a half. I think that's sort of a taste of what's to come. And perhaps, that's what the fire horse is going to bring us.
Okay. Stephanie, Happy New Year to you. Thank you so very much. Stephanie Leung is the CIO of StashAway, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.